Hello, everybody, and welcome to yet again another fun accounting video. This is going to be such a great time. I can't wait to go through and look at this. We're not going to be looking at drinking today, but we are going to be looking at liquidity. So, my dad jokes are getting worse and worse, but it's kind of punchy at 11:15 at night. So my disclaimer and copyright notice, the information and opinions herein are those of myself and including my horrible dad jokes. But they're my opinions and not any of my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So let's go ahead and take a look at liquidity ratios. What are these? This is if you're about to loan money to someone or you're going to do business with someone. These are very, very important because if I'm going to sell inventory to a retailer, I probably want to know when I'm going to be getting paid back. So, and again, this is usually going to be something if I'm extending credit, not being paid in cash, but I'm extending credit to someone. But these liquidity ratios are going to help us measure a company's ability to meet our short-term obligations using our most liquid assets. And the common examples of some liquidity ratios are the current ratio, current assets divided by current liabilities, the quick ratio, cash, marketable securities, and current receivables divided by current liabilities. And then lastly, this is by far the most liquid of all, are cash and cash equivalents divided by current liabilities. Now note, when you see the term cash equivalents, it essentially means any instrument that can turn into cash within 90 days. So that's usually how that will work. Let's go through and take a look at some ratios here for Five Below. So what we're going to go ahead and do is we're going to add in a new tab. So we're going to start here with our liquidity ratios. And we'll start here with our current ratio, current assets divided by our current liabilities. We'll do our quick ratio, which are the quick assets, cash, current AR, plus marketable securities divided by current liabilities. And then over here, we've got our cash ratio. And our cash ratio is going to be cash plus cash equivalents divided by our current liabilities. And what you want to kind of go through and remember, we're going to basically do this for Five Below for a period of 2 years. So for those of you who are in my class, you have two companies that you're going to have to go through and do this for. It depends on the class you're in. I think I'm giving this project almost all of my classes, but you're going to have to go through and do this for your companies for a period of 2 years. And why are we choosing 2 years? You could actually do it longer, but it's essentially going to be the best way to kind of go through and assess what a company's liquidity is. So 2/1/25. And then we're going to have over here of 2/3/24. Okay. So when we go through and look at the first one over here, and we're going to make this a little bit bigger for ourselves. Go. So the first one we want to go through and look at is, and this is, we're going to put up here 5, because we're doing this for Five Below. So the first one we're going to go through and do is we're going to look at current assets. And for our current assets is 1,351,000. For the prior year, it was 1,203,000. The current liabilities of these companies, 756,442. And then over here, you've got 715,926. So the current ratio is going to be 4 or 5 below. It's going to be 1.78. And when we do this, we want to run it. It's not going to be as a percentage, but we want to show this as basically as 2 decimal places. And then this is going to be 168. So the current ratio, you could say for 5 below, seems to be improving. For our next item up for bids is our quick ratio. Our quick ratio, we're going to go ahead and we're going to be looking at our quick assets. Now, here, this is going to be the cash and cash equivalents plus short-term investment securities. It's not inventory. Inventory is not a quick asset. And if I come over here and I look at this, I get 460.88. I copy this down here. So my current liabilities aren't changing. And so my quick ratio is 0.7. And this is over here at 0.64. So what we could say is that we could say that the liquidity or the quick ratio here, this seems to be improving for 5 below. Now let's go ahead and look at the final one over here, which is our cash ratio. And for our cash ratio, again, the current liabilities are going to be exactly the same. What's a current liability? It's any liability that's due within the next 12 months. So here, I'm going to basically take the cash and cash equivalents, and I'm going to go ahead and divide this over here by my, essentially over here by my current liabilities. And if you notice here, I'm trying to interlink in, basically if you click on each one of these, you can kind of see where the numbers are going through and coming from. So the cash ratio here for this company, let's just go ahead and copy this ratio down. So here are the liquidity ratios, right? So I would generally say that for a retailer, this is probably going to be looked at as pretty favorable in terms of liquidity. However, like anything else we go through and do, and I'm not going to try to give away too many things here, but if I looked at the cash ratio for Dollar General for this one particular year, and then I compare this to my current liabilities, so my cash ratio for Dollar General is roughly at about 13, or I shouldn't do that. It's not, that's not what it is. It's not a percentage. Sorry about that. I didn't mean to do that. Okay. It's 0.14. So my cash ratio for Dollar General is 0.14 as of, 1/31/25. If I look at this compared to the cash ratio for 5, it's not that good. Now, one other thing I just want to kind of show you, and again, when we do ratios, this is why we're generally going to be comparing them to other companies that are in the same industry. Now, one of the ones that may really kind of go through and scare you, and I don't mean to be telling you scary stories at night, but one of the things is that if we looked at Lowe's, basically Lowe's, which is really, it's much closer to the Home Depot. So the cash and cash equivalents for Lowe's is roughly about 4.8 billion, and their current liabilities are about 21 billion. So actually their cash position actually seems to be getting, seemingly getting to be like a little bit interesting. So again, when you look at a company like Lowe's, but of course, when we look at Lowe's, what's one of the things that we notice? Well, their total liabilities exceed their total assets. Probably something we want to go through and look at. So again, when you look at these, you really have to look at the ratios by companies. And so this is really the first step, is we're basically going through here and doing these liquidity ratios. Why do we do this? We want to see how quickly a company can meet its short-term obligations. this is going to be extremely relevant prior to us starting to go through and do business with others. One other thing I want to kind of mention, and this is something that, you know, when we look at financial reports, I'm pulling things from the 10K, which is the annual report. But if we notice here, I'm making this video as of October 21st, 2025. That means I'm looking here, if I'm looking at the 10K, you might say, well, Bennett, this number is like more than 8 months old. And that's exactly right. So if I came here and looked at Five Below, and I instead went to a more recent quarterly report, which is required to be filed 3 times per year. If we looked over here at Five Below, essentially what you would see is, well, their cash and cash equivalents have actually grown to about 562 million. And this is divided by 924. So we call this 563 divided by 925. It's actually improved, right? So for Five Below, this is better. Now, one of the things you should also keep in mind is the difference between a quarterly report and an annual report. The annual report is audited. A reviewed report is reviewed. There are definitely different procedures that go through, and you see this big thing over here, which says unaudited. Very, very important to remember as you're going through and looking at these different items. But those are generally going to be the liquidity ratios. You might also see something in there like working capital. But again, the ones I'm going to be focusing on here, at least for my classes, are the current ratio, the quick ratio, and then lastly, the cash ratio. And when you look at this, this is really focusing, you're really narrowing down the scope of liquidity. Why do we say that? Current assets include any asset we're going to be using in the coming year. And this includes inventory, it includes prepaid expenses. So as we look at that, we kind of say, well, with current assets, that's pretty broad. And some of those items may not be that liquid. So we're going to basically narrow this down. We're going to basically look at quick assets, and then we're going to be going through and looking finally at our cash ratio, which is going to be really testing that liquidity. One of the other things as well is that you might be seeing some other items that are buried in here, which like the lease obligations. And again, I don't really consider that to be a true, like, so when we evaluate ratios, this to me is kind of irrelevant. These two down here are, I think, much more relevant because at least here, you're looking at cash, current accounts receivable, and then marketable securities. So there you go. Those are the quick ratios. I want to thank you for being here with me, and hopefully you found this video to be helpful. Have a great rest of your day.